Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities, and historical data, all delivered via API, XML, and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to Econoday Unplugged. It's Tuesday the 16th of July 2019. Mark Pender is across the pond stateside and just a couple of days after England won the Cricket World Cup in what many are already calling the greatest match of all time. I'm Jeremy Hawkins here in a decidedly celebratory London. So, at least potentially for financial markets, this week could be the calm before the storm. We're now just 9 days away from a possible fresh round of monetary stimulus from the ECB, which could see its benchmark interest rate go negative for the first time ever. And of course, only a couple of weeks before an FOMC meeting that's widely expected to deliver the first cut in Fed rates in over a decade. Still, there's a lot going on, and amongst the other key Econoday calendar entries this week sees an important consumer updates and earnings figures in Mark's part of the world, and there's inflation reports out of Europe. So, Mark, what's going on? What should we be looking at?
Well, we're looking at trying to how do you explain cutting rates when the economy is accelerating? Now,
I was going to ask you that.
Now, yeah, they're going to, are they looking at incoming data or are they not?
What you've seen today before you actually say what it is, does that definitely rule out this talk of a 50 basis point cut?
Yes, I mean, it's going to rule out. It's going to rule out reasoning, clear reasoning, and trying to explain why they are cutting rates. We've had really a surge in retail sales in June in those components that are part of the GDP calculation, the control group, which rose 0.7%. Now, this retail sales report for June was no fluke. Lower prices for gasoline held down gasoline stations substantially, and department stores continued their complete erosion. But elsewhere, it was a very, very extraordinary report that led by e-commerce and including another month, 4 or 5 months now, a very strong acceleration in restaurant sales. Now, why do people go to restaurants? Well, because they have money, they have jobs, and the bulk of GDP is consumer spending. So that is a real, that's a real important positive for second quarter GDP this report for June. But then we also had another positive report for their sensitive, what the Fed is looking at, which is manufacturing. That was the industrial production report this morning. The headline was weak, but that was because of utilities, where weather plays a factor. But manufacturing production was very, very solid, at the very top end of expectations. And again, isn't showing the best showing of the year for manufacturing. This at a time when Jerome Powell was, talking about, a pivot lower for the sector. But they're looking across the oceans for all these problems, and I don't know if they're finding it right now in the manufacturing sector, but certainly the domestic economy itself isn't showing any cracks at all. And now this falls in line with the very first indication from June, if we remember, and that was a much stronger than expected 224,000 rise in non-farm payroll growth. And last week, we had a 0.3% rise, unexpected rise in core CPI inflation. So as far as the data are not falling in line with all these expectations and all their signaling of a rate cut. So what's going to be interesting is the convoluted text and argumentation that they're going to have to employ.
Presumably, what he says here could be a major test for, well, his own, Powell's credibility, but to some extent the credibility of the central bank as well. Because you're basically talking about a pretty decent set of numbers, which, ignoring everything else that might be going on at the moment, would have people thinking, well, there's no way the Fed's going to cut, and if the economy keeps going like this, given given how low unemployment is, etc., it's just going to be a matter of time before rates go up. So how do you sell the idea of cutting at a time when the data don't apparently justify it? Is it all about the forecast?
Yeah, well, they're going to have to stay in a neutral world without any expectations, and certainly without this backdrop of the administration pushing for a rate cut, and also other global banks. That's also part of this overall, picture that is moving to rate cuts. But how do you sell that? That is the unknown right now, and they're going to test, like I say, their ability to make arguments. This is going to be, I think, they're going to have to discuss how they structure their language, how they, present this to a reasoning public. And beyond, what the expectations have already set. So it's going to, I think, work against the Fed's credibility, not only on the sense of incoming data. Are they or are they not watching incoming data? And are they being ruled by outside forces, which is not, traditionally how monetary policy is supposed to go.
So I guess on the assumption that they're kind of, committed to a Fed rate cut to the extent that perhaps they'd almost dared not to do it, is it then going to come down in terms of looking for how the markets are going to react to what they do with any kind of forward guidance, what they do with a bias? If they come out and cut and kind of intimate, we still got an easing bias, chances are we're going to cut again. Could that be taken more negatively perhaps in some way than simply saying, right, we cut interest rates, we're on neutral now and see how it works out?
Well, that's an interesting point. So yeah, they'll get the cut out of the way, and then clean the slate. But there's more than just this issue of immediate rate cut. It's also the longer term a look at what Fed policy has been doing. It's been rising for several years now. It peaked in just recently as December. And then they threw things in neutral because of trade tensions and slowing global trade. And then we were okay for a couple of months in the early spring. And then all of a sudden we're bad again. And the economy is not in a good place, even though Jerome Powell last week brought the line out from earlier in the year that we are back in a good place. So they're not in a good place. The Federal Reserve is not in a good place in how they're going to explain their policy.
Okay, it's going to be an interesting one next week. And I guess sticking with the central banks then in terms of...
Well, Jeremy, may I ask now, mentioned, have you been... you mentioned the ECB may be cutting rates. Is that a little bit of a new bias?
It's certainly not definite yet, I've got to say, and I think the markets will be making up their minds over the course of the next few days, and in particular what Mario Draghi has to say. And I should mention that he'll be participating in the G7 meeting in France, which is due tomorrow, and he's expecting to be speaking then. Now, from everything he's said really since and including the last ECB meeting, he's essentially told markets that the ECB will be loosening policy in some shape or form. So then it really comes down to what analysts think he may do, in the sense that has he got much room left on quantitative easing? Could he actually come out and cut interest rates again? And I think at this stage the jury's kind of out. It'll firm up before we get into next week and the Thursday meeting itself. But I think at this stage, the analysts are still trying to work out exactly what they might do. But I don't think they'd just do an interest rate cut. And if they do reduce rates and put them into negative territory, just to remind folks that their refi rate at the moment is still 0.0%. It's only been like a 10 basis point cut or something like that. So I still think the onus would be on additional quantitative easing of some shape or form.
But in contrast to the Fed, are there immediate expectations for an ECB accommodation?
Definitely. I think now it's got to the stage. Well, let's back up. I said there are certainly very solid expectations that it's just a matter of time before the ECB loosens policy. The question mark is the timing, in the sense that typically when they do anything, it's attached to their updated economic forecasts, and they come out every quarter, and we won't be due another set of those until we get to September meeting. So in other words, we've got one meeting next week and then nothing until September. So the bet is strong that we'll either see something happening next week at the ECB meeting, or they'll delay it and simply do what they normally do and do whatever they're going to do once we get to the September meeting.
So will they do it in the language? Can they cut rates?
Well, I think if they've kind of decided they can do it in September, then the tone of it, as you say, the statement is going to be such that they're going to leave markets fully discounting some kind of ease before we actually get into September. And indeed, looking at the shape of the curve, I mean, that's increasingly built in now anyway. If you think for a long time that, the ECB, in fact, still effective, the ECB's bias is, longer term bias is upwards on interest rates, in the sense that all they've done of late is just to extend the period during which they're going to keep their referee rate at zero before interest rates move up. Well, markets have been dismissing that theory for a long time now and been working on the assumption it's just a case of, instead of keeping interest rates zero, they actually start going down. So what Mario Draghi has to say will certainly be important. I mean, in terms and in contrast to what you're getting your side, the latest figures, at least from the output side, have been, well, I should say, latest figures from the retail side have been poor, with retail sales down again in May. But we did see a stronger than expected bounce in May industrial production. That was reported last week, up 0.9% on the month. However, given how weak the rest of the quarter was, it looks as if second quarter industrial production at best is only going to manage a very small rise. And within that 0.9% monthly figure I mentioned for May, France was up over 2%. Which is a suspiciously strong number, and I expect some of that will be given back when we get into June. At the same time, we've had the Bundesbank issuing a warning about slowing services activity. So at this stage, it still looks as if second quarter GDP out of a Eurozone on a quarter-on-quarter basis is going to be, 0.2, perhaps 0.3%. So in other words, slower than it was in the first quarter, and certainly still not fast enough to push underlying inflation up to anywhere near this near 2% target the ECB operates with.
And what has the pattern been on trade for Europe?
On trade on the whole, well, one good thing, I suppose, as far as the ECB, or at least the Eurozone is concerned, is that the trade figures have been holding up pretty well. We had the merchandise trade data for May out earlier on today. They showed another fairly comfortable 20.2 billion season adjusted euro surplus for that particular month. That was up from just shy of 16 billion previously. And to be honest, if you were someone who looks at the trade numbers with a view to calling the currency markets, then the euro should have no problems at all, because it does have a relatively comfortable trade surplus. But I think one of the problems of these trade figures, particularly out of Europe, and I must say the UK is notorious in this, is that not a lot of weight is attached to them because there's real problems in measurement, and so markets don't have that much faith in them. And as and when this dreaded Brexit finally comes about, they may well have even less, because no one's have a clue what's going to be going on there.
So now, are you talking about monthly trade data coming out of the Eurozone?
I am. So 20.2 billion euros for the surplus for the month of May.
And there's a lot of volatility in the numbers?
It's not too bad. Obviously with trade numbers, we're simply, the trade balance, which is talking about the residual of a stocking rate inflow and a stocking rate outflow. So it will tend to move about quite a lot. But on the whole, actually, they've been relatively stable at round about 17, 18 billion, give or take a few billion, for quite a long while now. So despite all the worries about global trade issues and tensions and so on the tariff side of things, they've actually held up relatively well. However, part of that, you've got to say, has been down to the relative weakness of imports. So if you look at today's figures, exports actually had a good month. They're up 1.4%, but you also had imports down 1%, and they fell in the previous month as well. So again, that fits in with this idea that domestic demand across the Eurozone as a whole is in a pretty soft state, and hence, the justification for some kind of easing in ECB policy. Okay, well, I should also mention the UK, since the Bank of England is going to be scratching its head when it gets to its next meeting at the beginning of August. Obviously, everything here is still surrounding Brexit, but the market view has been very much that, assuming we don't get a disastrous Brexit, or even if we do, we'll probably see some kind of cut in interest rates at some point. However, key to the Bank of England, indeed, as you talked about on many occasions in the past, is what's going on with wages or average earnings as typically measured over here. And we had a surprise jumps in the earnings figures in today's labour market report. This is for the 3 months to May. So looking at regular earnings, which strips out any bonus payments, they're up on an annual basis at 3.6%. That was up a couple of ticks from the previous period, and more important, an 11-year high. Now, for those MPC hawks who don't like signs of higher wages because it equals labour market pressures and ultimately higher inflation, that's going to get them very agitated. So it's going to be the case, or potentially a worst case for the Bank of England, where most of the real side data are suggesting that probably UK second quarter GDP could be flat. It could easily be a small negative in there. But if we got the labour market still tight enough to push wages up, then there are going to be some people on the MPC who are going to want to cut, and some people on the MPC who want to push interest rates up. So it could make for quite a volatile time for UK money market rates, almost irrespective of what's happening to Brexit.
So what's your expectation? No action?
I think at this stage, the bank isn't going to do anything until it knows what happens to Brexit. The Bank of England's official viewpoint is that they still assume in their central case forecast that there will be a smooth Brexit, although they've acknowledged that the risk of a no-deal Brexit has increased over the course of the last couple of months or so. But assuming a no-deal Brexit, the official line is that interest rates are more likely to go up than down, but they'll only go up very slowly.
Well, isn't with the Tories now, doesn't it look like it's a sure bet that something is going to break on October 31st? Either there will be a hard Brexit or a soft Brexit, but something will happen?
Something's going to happen, you're right. Just to remind people, October the 31st is the current Brexit deadline. And under current UK legislation, whether there's a deal or not, that's going to be the end of UK's membership of the European Union, because that's what's written down in the statute books. So if we don't come out of the EU on the 31st of October, something somewhere has got to change. But it's still the case that whoever takes over Downing Street next week, I suppose it's just worth reminding people that Mrs May, she is due to tender her resignation on next Wednesday. Next Tuesday, we should know who the new British Prime Minister is going to be, either Boris Johnson or Jeremy Hunt. And they will take over number 10 Downing Street on Wednesday after Mrs May steps aside. Now, the problem is that to all intents and purposes, ever since Mrs May announced that she would be standing down, what was that, a couple of months or so ago, the only thing that's really changed in the whole process is that there'll be less than 3 months to go now before we're due to leave, rather than less than 4.5 to 5 months ago when she's standing down. The whole politics has not changed at all. You've got two candidates are both intimating that, well, A, they don't want a no-deal Brexit, but if they have to have a no-deal Brexit, they will do. Parliament is still maintaining that there's no way we're going to come out the EU without some kind of a deal. So at this stage, it really is what the heck's going to happen, we don't know. As you said, something's got to give. Well, it may be the case that what does give again is the blooming timetable. So this Brexit can gets kicked further down the road yet again, which is what all sides are saying they don't want.
Yeah.
But it is interesting, I think, from looking at the way the pound's been trading today, typically speaking, when you get strong wage growth in the UK, or indeed in most countries, and you've got a central bank concentrating on inflation, high wages, inflation risk, the currency tends to appreciate on the grounds that interest rates are less likely to go down, or who knows, perhaps even go up. As far as the pound's concerned today, it's basically ignored it. And it was a strong set of wages figures, which really surprised people. And it didn't go up, it's depreciated against the euro. A sterling euro cross, as we talked about before, is the litmus test of how the markets see Brexit. It's depreciating. It's been depreciating for a while now. And it really is a reflection that it's still, as far as the pound's concerned, all about what's going to happen to Brexit.
Well, are the Tories committed to an October 31st break of some kind? And without that, the Tories will stand down? How does that work?
Of course, the worry for them is that, well, let's, oh dear, end up being sort of, political diatribe here. But, as we talked about before, the politics of this for Brexit, it's not just split between party lines, Labour, the principal opposition party, and the Tories. It's split right across Parliament. So, within the Tory party, you have some people who want to remain part of the EU and some who don't. Exactly the same applies to the Labour Party and indeed the other opposition parties. So it really could come down at the end of the day to what Parliament can do. And there's talk about various rumours about Parliament might be suspended so that the new Prime Minister could force through a no-deal Brexit, because otherwise Parliament would veto it. But then there's question marks as to, well, how democratic is that? Could it actually be done? And so on. So the danger is for the Tory party as a whole is, if you look at the popularity of the party, well, all parties at the moment are so low that no one knows who would win.
The unpopularity.
Yeah, exactly that. If you're a Tory MP at the moment, the good news is you've got a job. If you have an election next week, you might not have any other day after. So it really is. It's a fascinating situation, and anyone who says they know what's going to happen, really is telling porcupines. Okay, what else? Do we have anything else? I should mention just quickly, sticking on the inflation front. We do have it out of Japan on Friday, late Friday, we'll get the June CPI there. And that's again expected to just underline the weakness of core prices in Japan. What does that mean? Well, one, obviously in itself, it pushes more pressure on the BOJ to come out and do something with their policy as well. Their bond yields are already well below what they're targeting. And of course, it makes it that much more important what the ECB and the Federal Reserve do. Because the Fed comes out and cuts and makes aggressive noises about cutting further. The dollar could weaken. And that's obviously a counterpart to that is that the yen's going to appreciate. And that's the last thing Japan needs when it's got inflation, round about 0.6% or so on the core rate. So there's going to be an awful lot of flack flying around depending upon what these central banks do or indeed might not do over the course of the next several weeks. Right. Mr. Pender, anything else to lob into the pot apart from congratulating the mighty England cricket team?
Yes, well, congratulations. Now, but
I do have to respond by saying I should have congratulated your ladies' football team, of course, for their magnificent performance not so long ago. Was it a week or so ago now?
That's right. Yes, that's right. Well, it was a 1-2 for the US and UK. Definitely.
Things are looking up. Okay, then. Right. Well, I guess we'll wrap it up there. So, as we mentioned, next week promises to be particularly interesting. And we'll add to the fun by having our Asian guru, Brian Jackson, join us to discuss what's going on in his part of the world as well. So until then, on behalf of Mark and myself, thanks very much for listening. Bye for now.
Econoday has provided value for the investment industry for over 25 years, amassing a comprehensive, machine-readable database of global market events. Our exceptional dataset consists of consensus, actual reported and revised numbers of economic events. Algorithmic trading firms, global banks, asset managers, hedge funds and AI technology firms are leveraging Econoday's unique historical dataset to fuel their proprietary trading models and support their research and compliance teams. Go to www.econoday.com and follow @Econoday on Twitter to learn more.